Hello, everyone, and welcome back. Today, we're taking a clear look at the Schwab International Equity ETF, ticker SCHF, as of late August 2026. SCHF is one of the largest and most cost-efficient ways for investors to gain broad exposure to developed market stocks outside the United States. It tracks the FTSE Developed ex-US Index, which includes large and mid-cap companies across more than 20 developed countries in Europe, Asia, and other regions. The fund holds roughly 1,500 stocks, giving it true diversification across sectors and geographies. One of the standout features of SCHF continues to be its extremely low expense ratio of just 3 basis points. That makes it one of the cheapest international equity ETFs available. The fund also pays a meaningful dividend, with a trailing 12-month yield currently near 3%. Assets under management sit around $70 billion, reflecting strong ongoing investor interest in international exposure. As of the close on August 24th, SCHF finished at $28.32. It is traded near its recent 52-week high of $28.69, which was set just a week earlier. Year to date, the fund is up roughly 18.5 to 19%. Over the past 12 months, the total return has been even stronger, approaching 27%. These numbers show solid performance relative to many peer international funds this year. Looking at the bigger picture, international equities have benefited from a combination of factors. Currency movements, improving economic data in certain regions, and a rotation of capital seeking value outside the United States have all played a role. SCHF's broad, market cap-weighted approach means it captures these trends without heavy concentration risk in any single country or sector. Now for the short to intermediate term outlook. In the near term, price action has been consolidating just below the recent high. This kind of digestion after a strong run is common and healthy. Volume has remained reasonable, and the overall trend structure remains constructive. Investors watching the fund should keep an eye on whether it can push through and hold above the recent high or whether a deeper pullback develops first. Looking out over the next several months into the intermediate term, the backdrop for developed international markets still looks supportive. Many non-U.S. developed markets continue to trade at more attractive valuations relative to U.S. large caps. Earnings growth expectations in parts of Europe and Japan remain solid, and any sustained improvement in global growth or further easing of policy uncertainty could provide additional tailwinds. At the same time, risks such as currency volatility, geopolitical developments, or shifts in U.S. interest rate expectations could create temporary setbacks. Overall, the intermediate picture favors a constructive bias for patient investors who maintain a diversified international allocation. SCHF remains a straightforward, low-cost building block for anyone looking to keep meaningful exposure to the developed world outside the United States. Its combination of broad diversification, ultra-low fees, and a respectable dividend continues to make it a core holding for many long-term portfolios. That's the current snapshot on SCHF. Thanks for watching, and I'll see you in the next update.